system, and then talk specifically about the financial statements in Design Manager. First, I'll give a little background of the Design Manager accounting system. Both Design Manager Standard and Design Manager Professional use an accrual-based accounting system. That's important because accrual-based accounting system follows generally accepted accounting principles, which is also known as GAAP. If you ever see the abbreviation with all capital GAAP. If your accounting system is not accrual-based, you can't possibly follow the basic principles of accounting as defined by GAAP. So in an accrual-based accounting system, basically there's two types of accounting systems. There's a cash basis and an accrual basis. In a cash basis system, everything deals with cash going in and out of your accounting system. So the reason accountants don't like to use cash-based systems is because you can't tell exactly what is happening in a cash-based system as far as your profit and loss in your financial statements. In an accrual-based system, revenue is recognized when it is earned, in other words, and it also matches exactly with your costs. So in an accrual-based system, when you pay for something that you buy from a vendor, so if we're buying a sofa from a vendor, it's held in an account called work in process. So what that is you pay the vendor $1,000 for a sofa, is held in work in process, which is similar to having inventory, but it's things that you just bought that are waiting to be installed at the project site. So it's held there until you invoice the client. And when you invoice the client invoice actually triggers moving it from work in process into your cost of goods sold, and therefore the revenue that is generated by invoicing the client for that sofa and the cost that was generated by paying the vendor for the sofa ends up in the same period with the client invoice. This allows you to get an accurate picture of your profit for that project or that piece of furniture in particular. Otherwise, in a cash basis system, if you pay for the sofa in 1 month and then you were to invoice it in the next, you're going to show a giant loss in the first month because you paid money for the sofa. And then in the second month, you would show a giant gain. So it wouldn't make sense as to how you're doing that particular month because the revenues and costs don't match up. So that's it in its very simple form. And when we go over the income statement balance sheet, I'll add we'll explain that in a little more detail and some of the other aspects of the accrual-based accounting system. So first of all, the financial statements are found under reports. So if you look in, this is Design Manager Standard right here. So if I click on Reports, I would go under General Ledger, Financial Statements, and then I have my balance sheet and my cash flow statement, or sometimes called Statement of Cash Flows as well. And then I have several types of income statements I can print. And income statement is also known as profit and loss. So if you are looking for, if you're used to a different system that you used earlier, they may call it the profit and loss statement. Income statement and profit and loss are the different terms for the exact same thing. So, and if you go over to Design Manager Pro, you want to click on Reports, General Ledger, Financial Statements, and here you have your balance sheet, your statement of cash flows or cash flow statement, and your income statements. So let's start out by taking a look at the income statement or profit and loss. So I'm going to print one up here. And this is very simple data. There's just a few items in here. So please forgive the amounts that are shown. But, because they're very basic in a normal business, of course, you would have way more salaries than $500. You probably have way more accounts here, way more accessories. But this will work for to simplify it so we can explain how this balance sheet comes together. So basically, the income statement or profit and loss statement is split into 4 sections. The first section is your sales or revenue. And what that shows is anything that you've invoiced out to the client. So here we're showing an accessories of, we sold accessories worth $1,076. So that's exactly what we billed out for accessories to our client. And furniture, lighting, freight, and so on. Professional services, that would be like time you billed out at your hourly rate. That would appear under revenue. Now, everything under sales usually has when it's tangible merchandise that you pay the vendor for, you'll have a cost of goods sold account that is the same, matches up with your sales account. So we have a cost of goods sold for accessories here. So I can see that my accessories was, I sold my accessories this month for $1,076, and it cost me $965. So if I look at all the costs there, then I get a gross profit figure, and that's the difference between sales and costs. Now, of course, there's more than just the cost of goods, the things I purchased from a vendor. We also have other expenses in the company, and those aren't easily related to the merchandise we sell. So those come under the operating expenses section. And one of the main ones is going to be your salaries, everything you've paid out to employees for salaries. Also, depending on your firm, you may have employee commissions, like commissions you give designers for sales of goods. And then you'll have, there's one here, it says telephone expense, just for example purposes, but you'd have a whole list of expense accounts. You'd have office supplies, telephone. All this goes in to generating those sales from the top section, but they're not easily, matched up with, if you sell a accessory, a lamp, it's not easily matched up to an operating expense, but there is expenses involved. The electricity of the lights overhead is even part of the expense that goes into selling that lamp to a client. So that's the operating expenses section. And then it comes down to a net income section. So the net income is basically the sales minus your costs minus your operating expenses. And there's an other income section and accountants use this to categorize things that they don't really fit into expenses or cost of goods sold, but it's really treated as an expense. So a lot of times you won't see anything in that category, in this category other, but once in a while an accountant will like to put something separate in there, like maybe it's there might be some kind of payment to stockholders or some kind of expense in that, and they might put that under that section, maybe a bank's fee or something like that. So that's the income statement in a nutshell. I'm just going to cover briefly the balance sheet, and we're going to save the cash flow for the end. So after I go over the balance sheet, I will answer any questions. So let's just take a look at the balance sheet. Okay, so the balance sheet, what the balance sheet shows you for your company is basically what the company's net worth is. So what you're looking at is all the assets owned, and anything prepaid is considered an asset as well. So if you paid out vendor deposits, that's an asset as well. So you're looking at all your assets. That's what the company owns. And then you're looking at your liabilities, which is what, like maybe loans you have that you've gotten for the company. Client deposits that you collect from your clients are a liability because you haven't done that work yet. And that's in an accrual-based system. And they're not converted to revenue, again, until that client invoice is done, which makes the client deposits you collect match up with the costs that you incurred when you're doing the job that you collected the deposit for. Another example of liabilities would be your credit card account. And of course, the main liability is your accounts payable, which is everything that you've gotten bills for, but you're waiting to actually write the check to pay the vendor. And then you have the equity section, and the equity section is basically defines the company's net worth. So this is what the company actually has to make it the company worth a monetary value. So your main things under equity are retained earnings. So this would be retained earnings comes from basically the income statement that we just looked at. So this is all the prior year net incomes from the income statement. So if we look if we go back to look at our income statement here, we had a net income of $816 this year so far. So all the previous years, that retained earnings matches. If we go back to the beginning of the accounting was ever done in the system, and we print an income statement for each year and add it together, that net income value will equal the retained earnings, which is everything that you've made in the previous year. So that's part of the value of your company. And then current year income, that's of course matches the income statement for the current year. So that's what you're making this year. And then, of course, common stock would be, this might also be owner's investment. It's called several things, but this is what the officers or owners of the company would have paid into the company to start it, or maybe they do an investment. They may make a salary but pay something back. That would go into there, and of course that also increases your assets on your asset side. By going into your cash when an owner pays an investment or puts money into the company. Okay, so right now I just gave a general overview. So what I'm going to do is pause and see if there's any general questions about it. And maybe based on your questions, that'll give us a direction to go on. If not, I'm going to continue and explain some of these accounts in a little more detail. So, Lindsay?
Joe, it looks like you're doing a great job because we don't have any questions.
Okay. All right. So
here we go. One just came
sure.
in, Joe, if you want to take
Sure.
it. Sorry.
Sure.
What are the percentages on the income statement?
Oh, yeah. So in an income statement, on an income statement, it's traditional that there's always a percentage down the side. These are always related to a percentage of sales. So basically, 17% of our sales was accessories. So that's why you're seeing a total sales here of $6,189. That's 100%. And then, so 17% of that 100 is accessories, 52% furniture, 24 lighting. The same thing with cost of goods sold. So what it's doing is relating this to a percentage of sales. So 15.6% of my cost of goods sold of my accessories is that's 15% of my total sales value. So my gross profit is, I'm making a total gross profit of 28% on my sales of $6,189. And my cost is 71.9% of my total sales figure. And same thing with operating expenses. my total operating expenses are 13.2% of my total revenue figure. So that's, and my net income, of course, is the 13.2%. I'm sorry, my operating expenses are 14.9% of my total revenue. And then when I subtract the costs and the operating expenses from sales, my income is 13.2% of my total revenue that I collected. So basically everything is based on the sales you're getting from your clients, all the client invoices you've done. So that's all the money you made, and then all these percentages relate to that figure. Okay, Lindsay, anything else?
Yeah, actually, we do have another one. We have one about equity, and somebody was asking whether that is carried over from year to year. And, I mean, it is, but if you wanted to elaborate on that at all.
Yes,
Joe.
there's a couple schools of thoughts there. Now I want to remind you that I'm been doing this for 23 years, but I'm not a CPA. I'm more of a tech support person, but I know a lot about accounting. So if you have any questions about how you want your equity section to look, it would be a good question for your accountant. But basically, yes, equity is carried forward from year to year. The changes in equity here, just traditionally on a balance sheet, retained earnings is all the prior year income, and current year income is what's going on in the current year. So basically, everything the companies earn is your current year income plus your retained earnings. Now, there may be, you'll see a negative amount under here oftentimes called owner's draw. So that would be, rather than, sometimes owners aren't paid a salary, they're paid a draw, which is just basically a check written out. And then your accountant handles the taxes for that on the back end. So if you see an owner's draw amount there, that may be a negative amount. Now some owners, just to make their statement look good for them, might have a current year owner's draw on a prior year owner's draw. So basically, all the checks you're writing in this year go to the regular current year owner's draw. And then at the end of the year, you may journal the current year owner's draw to 0 with a journal entry right on December 31st if your fiscal year end is December 31st, and journal that into prior year owner's draw, just to give you a better picture. But basically, anything that ends up in equity on this balance sheet stays there forever. Pretty much all the things on the balance sheet are total sums of the accounts from the very beginning of your accounting system. So in other words, that cash balance is the sum of everything that went in cash from the very beginning. The retained earnings is the sum of everything you've earned from the very beginning. So, and that common stock of $10,000 is the sum of everything that the stockholders invested or the owners invested from the very beginning. So yes, it does stay. Hope that was a long explanation, but hopefully I did it justice. So go ahead.
Okay, Joe, and we have one last one. It's not worded exactly correctly, but I think I understand the concept. The question was, when is the revenue recorded as income in this system? Maybe you want to talk about the invoice and how it goes from WIP to COGS?
Right. The revenue is recorded in Design Manager, leaving it as is, leaving the settings in Design Manager as is. The revenue is recorded as income when the client is finally invoiced. So let's go through a scenario. So you have a project, a new project. It's a home. You're going to go in and you're going to design the living room. So, and you're going to buy a bunch of furniture for it. So in order to start that project, you're going to want to collect a deposit from the client. So let's say you're estimating the project at $10,000. So you want to collect a $5,000 deposit. Without getting into how you would figure out what your deposit percentage would be, you basically normally want to collect a deposit that's going to cover your costs. So you collect a $5,000 deposit. Now, when you post that deposit into the system, what that's going to do is show up on your balance sheet, and it's going to show right here as liabilities on the client deposit. Because at this point, you haven't done any work for the client. You've just collected a deposit. So that's going to join all the deposits you're collecting from various clients for projects as a liability here. And it's also going to increase your cash. Now you'll go ahead, since you collected that deposit, you'll go ahead and you'll purchase that merchandise. When you purchase that merchandise and do a purchase order, you're basically telling the vendor that you're going to order that. Now, with the purchase order that you send out, with that PO, some vendors will require a deposit of their own. So if I want to order a $6,000 sofa for the living room, some vendors may require a 50% upfront deposit, or if I'm getting carpeting installed, they'll definitely require some amount of deposit up front. When you pay that deposit that you send out with that purchase order, then that gets recorded as an asset on your books. And of course it will reduce cash, but it will increase this vendor deposit assets because that work hasn't been done by the carpet installer yet. So basically that is money that your company owns. If you were to cancel that, they should be refunding that to you. If they don't refund it to you, then you would do another entry to expense that out of vendor deposits and onto your operating expenses. So basically your balance sheet is holding those interim amounts, like your client deposits you collected and your vendor deposits that you paid out. Now the next thing that happens in a normal progression is you would end up ordering furniture, paying deposits, and you would end up getting bills from your vendor. And when you get bills from your vendor, basically they would go into accounts payable. So if the carpet was installed and you paid the balance, then when you put that bill in, it's going to, of course, reduce your vendor deposit. So that'll go down. I don't have a deposit with that vendor, and I've now paid the carpet installer for the full install of the carpet, and my accounts payable will go up. And of course, that accounts payable will be relieved when you actually send the check off to the carpet installer. You may have 30 days to pay it. You may pay it right away, so it really hits accounts payable for a day or right at that point. And you may give them a credit card, so it may go onto your American Express card instead of going into accounts payable. But in any case, it becomes a liability until you actually pay the cash for it. Now, when you had that carpet installed, the actual carpet itself is a cost of goods sold amount, and would normally be a cost of goods sold amount, but you don't want to record that cost in that period that you're paying for the carpet, because we haven't invoiced the client yet. The client hasn't come and said, oh, this looks great, and you haven't done the invoice yet. So that carpet that you purchased is sitting in the work in process account, which is think of it as temporary inventory. If you were to order a sofa or a lamp or a chair, you may even have a staging area or a receiver that merchandise is sitting at. It hasn't even been delivered to the client site yet, and you haven't invoiced the client for it. You've collected a deposit, which is sitting here as a liability, but you haven't recognized any revenue. You haven't generally earned the revenue yet because you haven't installed it at the site. So at this point, like when we have the carpet installed, when we take the sofa to the client site, we would generally deliver it. We would generally invoice it. At the time we invoice the client, then it would apply the deposit to that invoice. So I'd be invoicing the sofa for $6,000. It would say less deposit $3,000, and the balance due to the client would be $3,000 if we're just talking about the sofa. So basically, that will relieve my client deposits, and it will relieve my work in process, which is the cost, what the sofa cost me to buy. And everything at that time, at the time the client invoice is done, all those things, the work in process, which is what I purchased for the client, and the client deposit, which is the money I collected up front, at the time that client invoice is done, it all moves to the income statement. So at that point, that client invoice triggers the move of everything. I would see my furniture go up, you know, $6,000 for the sofa I sold. I would see my furniture cost of goods sold go up, you know, $2,500 for whatever that sofa really cost me when I bought the vendor. So that total, you know, that client deposit is down $3,000 because revenue went up $6,000. So it's all keyed on that, on invoicing the client at the end. So invoicing the client at the end basically recognizes all the revenue. That's a long explanation, but it's a very important concept, because that's why accrual-based accounting, that's why you hear accountants saying, oh, you need to run on an accrual basis. Because what that does is allow you to actually see the profit you made on that client invoice all in the same period. If you did it on a cash basis, then, you know, then there is no client deposit account on a cash basis. So that deposit you collected 2 months before you even got the carpet installed, that client and the sofa delivered, that client deposit would show up as revenue in that period, which makes no sense because you haven't even done any work or incurred any costs. So it skews your books. In an accrual-based system, everything is kind of held on that balance sheet, so it increases or decreases the value of your company, but doesn't count as profit until all the costs are collected. So it's at the time that the revenue and costs are recorded, at the time that the sale is earned, at the time you deliver the goods, basically, is when you want to do your invoicing. So that's a long-winded explanation. Lindsay, you have anything else?
No, that's it. You can continue on.
Okay. Well, by covering those questions, they were really good. Kind of ended up what I was, you know, covering mostly what I was going to explain next, which was the flow through the system. So that example I used, that sort of covers the second half of my thing. So what I'm going to do is just talk briefly about the statement of cash flows.
Actually, Joe, I was just gonna suggest that, because there was a few people that had questions that were, you know, concerning, is it really done at the time of the invoice? Does the revenue get recorded then, or is it when you collect that final payment? We had a little bit of confusion about that.
Oh, okay, from the client.
This will help then.
Yeah, yeah, that'll help a little bit. I'll go back and cover that, because there's really one more step to that balance sheet. So basically, yeah, when you do that client invoice to the client, in an accrual-based system, that's when you're marking that you've earned that money. Basically, you've done that job. It has nothing to do with the client actually paying you. So what happens is you want to know that the client owes you that money. But as far as an accrual-based accounting system go, you're counting on the fact that you're going to make that money. So what happens is when you do that client invoice for this sofa and this carpet, you end up increasing an asset account called accounts receivable, which is a list of all the invoices the client owes you. So to get an idea of what the accounts receivable is, and accounts payable and work in process, there's a set of reports under each category. So under accounts receivable, we have aged accounts receivable. And if we print that out, we can see the invoices that the client owes us. And these things, we've already made that profit. Our income statement is showing us that we made a $3,000 profit on that sofa carpet job. But we haven't collected the money yet, so we're going to have the $3,000 balance, you know, the $6,000 invoice less the deposit we paid, because the client still owes us that. So basically our income statement, as far as our income statement goes, it's done, but we have a little bit of follow-up on the balance sheet in that invoice is sitting on our accounts receivable waiting for our client to write us a check for it. When the client writes us a check for it and we put that into the system, of course it's going to drop off of our accounts receivable, and it's then going to increase our cash. So that kind of leads into our statement of cash flows. What a statement of cash flow does is it reconciles your income on your balance sheet to how cash is flowing through your accounting system. So basically what it does is it starts out with the net income, and let's see if we can bring one up here. Oops. I'll do it from the beginning of the year. You can pick any period range here you want. Let's see what we get. So I'm doing it from the beginning of the year here. So what the cash flow is saying is that if you remember on our income statement, we had the $818 in net income. That's what the company brought in after paying salaries and everything. And what it's saying is, what a cash flow does is it relates everything to that net income by looking at the activities that income came from. So basically, what it does is it takes that income and it adjusts it for your accounts receivable. So the accounts receivable here needs to be taken into account because that is not cash that you've got. So your inventory and your work in process, this reduces your cash because it's cash that you've already paid out. Vendor deposits you've paid out as well. Your accounts payable needs to be taken into effect. Your client deposits, because that's stuff coming in. Now, why is the accounts payable a positive number here? That's because you've realized that expense. In other words, you've entered the bill that you paid the vendor. So when you purchased that carpet and did that carpet install, you paid the installer, but you haven't, and you've paid for the carpet, but you may not have written a check to them yet. So nothing has affected cash yet. You're realizing the expense, so your income, and you may have even invoiced the client, so your income's your income ends up being $818, but your cash hasn't changed because you don't owe that carpenter for maybe 30 days because that's what their invoice says, net 30 days. So that's why this is a positive number, because that number goes back into cash because you haven't paid that cash yet. So then that gives you like a net cash flow from your operating activities. So basically, this is showing like it's good. We're showing a positive number here, so we have a positive cash flow. And then the cash flow statement continues on, and you have other deferred liabilities like what your balance is on your American Express. And then you end up with a beginning and ending balance in cash. So basically, a cash flow statement attempts to, take those accounts receivable because you haven't gotten cash for that yet, take your inventory, work in process, everything in process, and give you an idea if you have a positive cash flow to make that net income. So, a lot of times accountants look at the cash flow statement with you. That helps. If you're starting out with your books or your business in accounting, it may be a good idea to keep an eye on your cash balance, learn what these accounts mean on your balance sheet, keep an eye on your income statement, make sure you're making a positive net income. When you're all comfortable with that, take your cash flow statement, talk to your accountant. I mean, he can really explain, your numbers in detail there. So, Lindsay, that pretty much sums it up. So I'll answer any other questions we have.
Okay, we just had one come in.
Sure.
Where is the beginning cash coming from on the cash flow statement?
Oh, okay. Let's go back and look at the cash flow statement. Yeah, the beginning cash balance. So when I printed this cash flow statement, let me just close it and print it again. So when I printed this cash flow statement, I said I want to see my cash flow from the beginning of the year through September, through the end of this month. So when I said that, and I said okay, what it did is it's finding out what the net income is as of the end of September, and it's looking at what affected these accounts since January through the end of September. So basically, when it shows the beginning cash balance, that is my cash balance as of January 1st. So I'm running my cash flow statement from January to September. So my change in cash, so my cash increased $33,000 between January 1st and 9. So here's it's basically this month is the beginning balance and that month is the end. So if I look at my balance sheet, if I printed my balance sheet for month 1, I would see that my beginning cash balance, well, actually the end, I want the end of 12/31. I would see that my beginning cash balance is $22,000, and my ending cash balance is then $56,000. Now that's all the cash together, so it may be your savings plus your checking. So that's all the cash together. Anything else, Lindsay?
Just where the ending cash comes from.
Yeah, so the ending cash would be the cash balance as of the end of the cash flow statement. So it's basically the date range I selected. So I selected to see my cash flow from January through September. So January, the beginning cash balance would be the cash I had as of the very first second in January 1st. And the ending cash balance would be the cash flow I have as of the end of September, or September's over yet, as of whatever is in the month at the current time.
All right, Joe.
So whatever I pick.
That's all the questions that I have so far.
Okay. You know, financial statements can seem like a daunting subject, but it's a good thing to keep an eye on and learn how to read, because it really helps you out in showing your business, and a lot of times your accountants can sit down and help you out with it too. I just want to point out a website that I use, and let me see if I can call it up here. It's called accountingcoach.com, and if you go into that site, there is this accounting basics section. So if you're really interested in finding out more about what I've said and how accrual-based accounting system works and why you use an accrual-based accounting system and why it's easier to see how your company's doing when you keep your books on accrual basis, this is a good site to go to. So that's accountingcoach.com, and there's a lot of information here. But this accounting basics section I've read through, and it does a very good job at just explaining the basics. And there's only 7 parts. So I recommend going there. Also, we're going to have these instructional webinars every Thursday. So we'll be covering some of the topics in more detail, like work in process and client deposits and markups and things like that. So keep an eye on the webinar schedule as well. So that's it. Lindsay, you can wrap it up.
Okay, Joe, and then just one last thing. How often would you recommend running these reports?
Well, at the very least, you want to run the reports at the end of every month. So basically, at the end of every month, this kind of gets into a bookkeeping subject, but at the end of every month, you want to check your balance sheet and income statement. You want to make sure that you have a positive net income for that month. I mean, that would be good. Negative net incomes are okay too, because you're paying salaries out of that. But you want to check these statements every month. You also want to check, every month you normally want to check your aged accounts payable, your accounts receivable, and you want to look down those lists. So if I did my accounts receivable, this is what my clients owe me. You want to look down this list. Now, this data has been sitting here for a couple of months because it is test data, but I can see that some of this client at least, hasn't paid me for 90 days. So I want to get on that, or I want to look for things on here that don't belong and address those issues because, maybe it's an invoice the client's never going to pay me for, and I want to write that off to bad debt, and so forth. And the same thing with the accounts payable, which is things you owe vendors. You want to print that too and kind of look through it and make sure this is really all the stuff I owe. I'm waiting to pay vendors for. I mean, if you see anything old on here. So you have your income statement, your balance sheets. Your cash flow statement is more of an analysis report. You probably don't have to print that every month. You certainly can look at it. Certainly you would check your income statement maybe as the month is progressing. You can print it for that month at any time so you can see how you're doing. Your accounts receivable and accounts payable are important to print at the end of every month at the very least, if not check them at every week to make sure your things are getting paid. The couple other reports is open vendor deposits. So this is going to show us everything that we've sent to vendors out on deposit. So it's a good report to make sure that you're actually recording your final bills from vendors. If you pay 100% deposit, sometimes the vendor won't send you a final bill. A lot do. They should. But if they don't, you may see something that's been sitting here for a while, and you may have to put through just a vendor invoice to clear your deposit. So that vendor invoice would be zero balance, so it would be like if this was 100% deposit for whatever we bought from this company, I'd put a vendor invoice through. The cost would be $12.50 for this chair we bought, and then it would say less $12.50 deposit because I paid 100% of it, and then the balance would be zero. And what that'll do is just wash it out of your vendor deposit report. So vendor deposit's important to run every month, and also your open client deposit. So this is basically things, projects you've collected a deposit for. So you've collected money from the client as a deposit to do the project, but haven't invoiced yet. So there's still a deposit balance, or you haven't invoiced everything. So that's an important report. So at the end of the month, I would definitely look at your income statement balance sheets that we just went over, but also your open client deposits, your open vendor deposits,